All right, ladies and gentlemen, I have two after the hour. My name is Steve Meredith. I'm the Business Finance Manager here at the Southwestern Pennsylvania Commission, and this is entitled Removing Barriers to Borrowing, How to Streamline Access to Financing for Small Business Startups. The presentation is meant to be a primer to get small businesses and specifically startups, those businesses that are either in the pre-venture stage or possibly in business for 3 years or less, ready to borrow from SPC and other economic development lenders. I've noticed in my daily conversations with pre-venture and startup businesses that most of the businesses that I run across have one or many of the barriers that I'll be mentioning today that prevent them from borrowing from SPC. Now, while this presentation is geared towards helping businesses to borrow from economic development lenders, much of this information also applies to businesses borrowing from traditional lenders as well. Before we get into the meat of the presentation, I'd like to take a moment to talk to you a little bit about what SPC is as an organization. We're a regional planning agency. We're a metropolitan planning organization. We're a local development district, and we are a partner, a core funded partner and fiscal agent for the Southwestern Pennsylvania Partnership for Regional Economic Performance, the PREP program. Now, all of that sounds like alphabet soup, but from an economic development perspective, and specifically from an economic development lending perspective, SPC is here to help the Southwestern Pennsylvania region's economy grow and prosper. So, today's agenda covers a couple of different topics. We're going to talk about the common barriers in the lender-borrower relationship, how to remove those barriers to borrowing, and then next steps for your business or startup that you can take to get ready to borrow from economic development lenders. And then we'll have a few minutes of Q&A at the end. But this is just another reminder that a lot of the information that I have contained in today's presentation is applicable to clients who want to borrow from SPC, but these tips can also be applicable to small businesses that want to take a loan from a traditional bank or any other economic development lender. So what are some common barriers to borrowing? I'll have a separate slide for each of these barriers and go a little bit further in depth, but the list on the screen are common barriers that most borrowers face when seeking business financing. First and foremost, I think the first one that people think about the most is borrower credit. They have to have a strong enough credit rating to be able to take any sort of loan. Lack of clear business plan or financial projections. This is a pretty big one that I deal with from a lot of startup businesses specifically. They have a great idea for a business, or maybe they've been in business, maybe they've filed the appropriate business paperwork with the state, but they don't necessarily have a business plan that has been reviewed by the SBDC or any of those kinds of entities. Lack of equity injection. Many private banks and economic development lenders require equity or cash injection from the borrower to make these deals work. So we'll talk about that a little bit further in depth as we go further into the presentation. The borrower is what is known as short on collateral. We will define what being short on collateral is, but this is a common barrier that can be overcome, but it is a common barrier that I have found. Sometimes the borrower is not able to meet job retention and creation metrics. When you take a loan from a small business economic development lender, most, if not all, of those lenders are going to have job retention and creation metrics, i.e., you have to either create or retain so many jobs per X number of thousands of dollars borrowed. And if you aren't able to meet those job retention or creation metrics, the deal may not go anywhere. The deal might not even go to the loan review committee. So you need to keep those in mind. And then lastly, lack of cash flow to service the debt. This can often be an unknown barrier to borrowing, but if you are not bringing enough cash to service your existing debt, lenders may not want to lend to your business. They may not be able to lend to your business based on their underwriting guidelines. So let's jump right in. The first, the first barrier to borrowing is borrower credit. Okay. Now, before I get into this slide, I think this is the barrier that one of the people, that most people think about before they even go for a loan. They think, okay, well, what's my credit rating? Or do I have a strong enough credit rating to get a loan? Okay. A lot of what I have to say on this slide in particular is common sense, but obviously you want to make sure you know your credit score. Remove any negative items from your credit score. You may have negative items on your credit report that have been satisfied. If that is the case, you need to provide SPC with documentation of satisfaction, mortgage satisfactions, etc., so that we can provide that paperwork to our loan review committee to mitigate any negative effects. Okay. Avoid charge-offs. Okay. Charge-offs are declarations by a creditor that an amount of debt is unlikely to be collected. Okay. On a credit report, it can sometimes show up as a zero balance, but this is very misleading. Okay. That does not mean that the loan or financing that you took is paid off. Rather, it means that any amount left unpaid is unlikely to be recouped by the lender. The lender has essentially said, okay, let's cut our losses and charge this loan off. It's very bad. Okay, so you want to avoid charge-offs as much as humanly possible. And then again, you want to monitor the number of credit history inquiries on your credit report. This again is one of those common sense things. I think a lot of people know that the more times your credit history is pinged for an inquiry, it can affect your credit rating, and it will be labeled as such on a credit history report. Too many credit history inquiries in a 12-month period is how they usually put it. Okay. Lack of clear business plan and projections. Okay, so business owners must have a clear business plan and projections before approaching any lender for any sort of financing. But it's important to understand that your business plan is more than just an executive summary. Okay, a properly developed business plan has to have at least the following sections on the screen: executive summary, team overview, investment opportunity, an overview of the company, an industry analysis, including the analysis of competitors, desire or market of the product or service, and or analysis of potential customer base, and then a financial overview. Now, before I go any further, I have 4 of these business plan sections listed on the screen. However, a fully formed business plan can be upwards of 20 pages in length. The 4 business plan sections that are listed on the screen are basic sections that all business plans must have, but you can and should break your business plan down further into the following specific areas. Okay, executive summary, company description, description of the products or services with a focus on the customer benefit, market analysis featuring targeted customers, competition, and market outlook, marketing strategy and implementation, outline of organizational structure. Who's who in your organization? Who's the CEO? Who's the chief financial officer? Who runs day-to-day operations? Financial plan with projections. Typically, business owners or business bankers, excuse me, require a financial plan and projections 3 years in advance. So the first year, second year, and third year of your existence as a business, what are those financials going to look like? Okay, and then finally the funding request. Typically what you will do is you will say, okay, I need X amount of dollars. I need to finance X amount of dollars for the purchase of a building or the purchase of equipment, something of that such nature. And then I cannot underscore this point enough. Make sure you utilize the local Small Business Development Center when crafting your business plan and projections. This is crucial because economic development lenders will want to see that your business plan has been reviewed by a Small Business Development Center before you take a loan with those organizations. Furthermore, if your business plan is reviewed by an SBDC, it should say so on the cover page of the business plan. If you need help finding a Small Business Development Center nearest you, let me know, and I'll be happy to connect you. The SBDCs should be the first stop once you have a fully formed idea for your business. They can help you craft your business plan and help you set realistic projections for profits and expenses. If you are a startup, i.e. you've been in business less than 3 years, you will need to provide your lender with a copy of your business plan and projections in order to apply for a small business loan. And Juan Williams, I just want to mention you put in the chat that you asked a question about participants getting a copy of this presentation. I am happy to give you a copy of this presentation. If you just put your email address in the chat, I'd be happy to do so. But yes, we can definitely get you a copy of this presentation. Thank you.
Okay, thank you.
No problem. Moving right along. Lack of equity injection. Okay, this is a big one, all right? Equity injection is essentially equivalent to borrower's skin in the game, okay? Most lenders ask for 10 to 20% equity to be infused into a loan deal. If you look at the box in gray at the bottom right-hand corner of the screen, SPC's traditional loan structure is we ask for 10% equity from the borrower, and then the remaining project cost is split between SPC and a private bank. So SPC gives 45% of the total project cost, and the private bank gives 45% of the total project cost. Now, equity can take a few different forms, okay? It can take the form of cash from the owner, obviously, but you can also count previous purchases that are part of the project. Sometimes I will have a borrower that will come to me and say, well, I've purchased XYZ as part of the project. Can I use that as part of the equity injection? Yes, you can. And we can definitely use that as part of the equity injection. We just need proof of purchase, receipts for any equipment you've purchased or any materials or supplies that might be going towards a renovation. Please provide those kinds of receipts and we can put that towards the equity injection of the project. Okay? If the borrower is short on collateral, okay, this is a common problem for a lot of small business borrowers. Essentially, this means that if the loan goes the loan goes bad, the bank would not fully be able to recover the value of the loan proceeds from the sale of the assets offered as collateral to secure the loan. Okay, in certain situations, the borrowers can overcome this challenge, and we will discuss how we can overcome that challenge in a few slides. Now, if the borrower fails to meet the job retention or creation requirement, okay, like I said, every economic development lender will have certain job retention or creation metrics. For SPC, a borrower must retain one job for every $35,000 borrowed or create one job for every $50,000 borrowed. And that job creation or retention requirement must be obtained, must be met by the end of the first 3 years of the loan's term. Okay, so it doesn't matter how long the total loan's term is. It could be a 15-year building loan. It could be a 10-year equipment loan. Okay, but you have to meet that $35,000 retention requirement or $50,000 borrowed requirement, $50,000 creation requirement by the end of the first 3 years of the loan's terms. Now, if you cannot create or retain jobs with your project, okay, you could fail to qualify to borrow the amount of money that you need from an economic development lender. The other negative aspect of failing to meet the job retention or creation requirement is that you don't get to take advantage of having your interest rate locked in for the life of the loan. Okay? One of the reasons people come to an economic development lender is because you can get your low interest rate, that 1 or 2% interest rate, locked in for the life of the loan. So if you're taking a 15-year building loan, you could have that loan at a 1% interest rate for the life of the loan. But if you fail to meet that creation or retention requirement with the jobs, many economic development lenders have a provision where they have to raise your interest rate if you fail to meet that job retention or creation requirements. So the last bullet speaks to the rest of the slide. When you are estimating the number of jobs that you're going to create or retain, be conservative in those estimates, okay? Don't tell the government, don't tell your economic development lender that you're going to create 20 jobs when you really can only feasibly create 10 in 3 years, okay? Be conservative in those estimates, okay? Then finally, lack of cash flow to service the debt, okay? This can often be a barrier to borrowing that not a lot of people know about because many small business owners might not know their debt service coverage ratio off the top of their heads. And quite honestly, I don't blame you if you don't. Okay, it's not a normal thing. It's not a regular thing that people think about all the time, right? People are thinking about, okay, do I have, enough cash to pay my bills? Did I make enough sales in the last month to meet my expenses? Those are the kind of things that business owners think about on a day-to-day basis. They don't think about their debt service coverage ratio, okay? That said, both private banks as well as economic development lenders will look at a business's ability to meet its current debt obligations when underwriting a new loan, okay? Debt service coverage ratio, DSCR, is a common banking term used is that you have to have the debt service coverage to meet both your existing debt and the new debt that you're about to take, okay? And the debt service coverage ratio is calculated by taking your net operating income and dividing it by your debt service. Net operating income is typically found on your company's cash flow statement, and your debt service is the total amount of cash required by a company to pay back its debt obligations. And it is typically expressed as a decimal. Okay, so let's take an example on the screen. If Joe Schmo's ice cream shop has a net operating income of $560,000 per year, and they have a debt service of $340,000 per year, then Joe Schmo's total debt service coverage ratio, his annual debt service coverage ratio, would be 1.64. Okay? Now, if you have a debt service coverage ratio of 1 or greater, okay? That means that you have more cash flow than debt, okay? But if you have a debt service coverage ratio of less than 1, it means that your business has negative cash flow or not enough cash flowing into the business to meet your existing debt, okay? So you do want your debt service coverage ratio to be over 1 in order to be able to take on additional debt, okay? If it's under 1, it could be indicative that you could be in trouble coming down the line, that your debt is going to overtake the cash flow, and you could, without economic adjustment, without adjusting your cash flows and adjusting the amount of money that comes into the business, you could be in trouble coming down the line in a few months. Okay, so make sure the debt service coverage ratio is above 1, and you should be in good shape. Okay. Now, how do we remove these barriers to borrowing? Okay, first of all, consider your credit worthiness. Okay, that almost goes without saying. You want to make sure that you have a credit rating that is good enough to take a loan. From SPC's perspective, we can lend to any borrower that has a credit rating of about 650 or higher. Okay, just so you know that. Ensure that your business has an updated business plan and projections, and if you don't, contact your local small business development center. I can certainly help you find who that is and get you in touch with the appropriate people. Okay. Consider all sources of equity in the project before you approach your lender. Okay. Consider the amount of cash you have. Consider the amount of items that you've already paid for. All of those can be equity sources for a project. Fourth bullet, determine the value of the item that you're financing from a collateral perspective. So if you're purchasing land or a building, the bank will likely require an appraisal on that land or building. And you'll want to be cognizant of the value of the property that comes back from that appraisal. If the building appraises too low, it could result in a collateral shortfall because the value of the building is not worth the total loan amount that the bank is going to be lending to you. Okay. Likewise, if you are financing renovations as part of your project, you will need to receive your contractor estimates before you finalize your loan request. If you guess the cost of your renovations rather than relying on contractor estimates, and then your contractor's costs come back higher than you expect, you could find yourself in a collateral shortfall, and in addition, you could end up taking a loan, closing on a loan that is essentially not enough money for you to complete your renovations. Okay? In addition to offering the asset being purchased as collateral, the bank or economic development lender will probably ask for personal guarantees from certain owners. For SPC, we ask for a personal guarantee from any owner with 20% or larger stake in the business. Okay? This allows the bank to pursue personal assets after the business assets offered as collateral are sold. Okay? Finally, if you do find yourself short on collateral, consider additional cash injection or offering another major asset you might have as collateral to secure the loan. Typically, if people find themselves in a collateral shortfall, they will offer their private residence to help secure whatever remains of the loan proceeds. Okay? Fifth bullet, how will this project help you retain or create jobs? As I mentioned in previous slides, be conservative about your job creation or retention goals. Okay? And then sixth bullet, does your business bring in enough revenue to service your debt? If you aren't sure, then you need to review your company's financial statements. Find your net operating revenues on your cash flow statement and add up your debt service, then perform the quick calculation that I mentioned earlier in the slide. Okay? It will provide you with peace of mind to know where you stand and where you need to go in order to take on additional debt. Okay? Next steps. Okay, so it might not be time for you to talk to a lender yet. You might need to approach your SBDC to get a business plan in place, to get projections in place. Okay, it's important that when approaching lenders, you need to have your business paperwork in hand. This means a copy of your business plan and 3 years worth of projections, 3 years worth of business tax returns for existing businesses, 3 years worth of business financials for existing businesses, copies of formation documents, personal tax returns for anyone guaranteeing the loan. Okay. Now, with regard to business taxes or financials, okay, I can tell you right now, economic development lenders and bankers prefer to see accountant prepared financials rather than business prepared financials, because generally accountant prepared financials are more thorough. Okay. That being said, if you are new to business and you haven't had the time or the money to secure the services of a CPA, you can certainly find or use QuickBooks, FreshBooks, and Excel to draw up those financial documents. But as soon as you have the finances available from your business profits, I would counsel you to retain the services of a certified public accountant so that you can sort of hand that off to them. Still keep in contact with them to review those business financials every so often, because ultimately the business owner is responsible for knowing how your business is doing at any one time. But in terms of the creation of the business financials, having a certified public accountant can certainly help in that arena. Okay? And then finally, before applying for financing, research the positive and negative impacts of the loan. Okay, how much debt does your business currently have on its books? And can the income that your business is generating support both your current debt and the additional debt of a new loan? I can tell you right now that your economic development lender, be it SPC or another economic development lender, they don't want to put you in a position where your business has so much debt that it cannot cover the payments from month to month. Okay, so if we notice that you don't have the cash flow to service the existing debt or the new debt, we're probably going to take a look at you and say, hey, listen, you just don't have the cash flow, and we're not in the business of sinking your company. We're in the business of helping your company expand and grow. Okay, so with that takes me to the end of my presentation. I want to give you my contact information on the screen here. This is my office line, 412-391-5590, extension 325. I will say that I'm in the office 3 days a week, and then I work from home 2 days a week. So I'm in the office Monday, Tuesday, and Wednesday, and then I work from home Thursday and Friday. So the best way to get a hold of me is probably through email. And then I also want to plug two things. First is SPC's brand new online loan application portal. Okay, if you go to the link listed on the screen, if you are curious to find out whether or not you will qualify for an SPC loan, you can visit that link on the screen, and you can take you can sign up for a free account, excuse me, and you can take our online loan pre-application questionnaire. And essentially what that's going to do is that's going to tell you right off the bat whether or not you qualify for an SPC loan. And if you do qualify for an SPC loan, I will get an email saying, hey, this person submitted an online pre-application questionnaire. It appears that they're eligible. Please review their questionnaire answers and please reach out to them in 72 hours. And that is what I will do. Within 72 hours, within 72 business hours, I should say, I will reach out to you to discuss your project in further detail. And then finally, I always like to connect with new business owners on LinkedIn. So if you want to connect with me there, please feel free to visit the link and connect with me there as well. So what I'm going to do at this point is I am going to see if there are any questions in the chat. Doesn't appear to have questions on the chat, but if you have a microphone and you would like to ask your question live here, I will turn on my video so you can see my face and that I'm in the office. So feel free to ask questions either in the chat or live via microphone as well. And thank you very much for attending today. I really appreciate it. Quick check of the chat. I will get this presentation to anyone that puts their email in the chat function, so I really, really appreciate it. And I will send you the slide deck so that you have it.
Yep, good afternoon, Steve. Mostly just wanted to do a quick introduction. My name is James Reed. I work at the Urban Redevelopment Authority of Pittsburgh. Just really wanted to give some positive feedback to this presentation. I thought it was very informative and very well organized. These are a lot of the barriers that we see with people coming into our financing or looking for financing from the URA. And also, as the URA excuse me, is an entity that is involved in land transactions with a lot of our smaller or minority women business-owned real estate developers. We also see these same sorts of barriers. So it's just great to have this material as something to help really pinpoint where those problems are and help us organize how we can better adapt our tools to help people succeed before they start coming in for those products or trying to purchase land from us. So
Excellent.
Just really appreciate it.
Hey, no problem. And that was one of the reasons why I sort of developed this this webinar. And I have a couple of other webinars as well. I have a webinar on small business financial health that goes over the three main financial documents that all small businesses need to basically craft and maintain to have a healthy small business. I'm planning on having a webinar in February that's going to essentially be where to start when starting a business. Talk about the essential considerations that you need to think about even before you approach the SBDCs. How much planning goes into planning a small business before you even open the doors. I think there's a lot of planning that needs to happen before you take that leap and you start looking for real estate or you start looking to, actually bring in revenues. So appreciate the feedback, and more of these kind of webinars to come in the future, I can guarantee. So hearing no other questions or comments, again, thank you so very much for being here today. I'm going to go ahead and stop the recording. And you guys have a great rest of your afternoon. And if you have any questions, feel free to shoot me an email. Thanks very much.